This video will work through problem 4.8 from Gapenski's Healthcare Finance, 6th edition. Okay, we are presented with a very simple income statement as well as the balance sheet statements for University Hospital for the end of 2015 and the end of 2014. We're given some additional information that the hospital didn't pay any dividends, that there were no transactions affecting equity during 2015. Meaning they didn't sell stock or get donations. I think this is assumed to be a not-for-profit. So nothing external happened to the equity account. No collections on the accounts receivable, but all receivables are considered collectible. So that means that if they didn't collect anything, then the new receivable amount should represent patient service revenue. And there was no charity care. And then the university purchased all its medical supplies on account. All right. So a little bit of a detective game, if you will. See if you can, if that's, yeah, I don't know how well you can see that. So let's start with the most straightforward part of this problem, which is actually the bottom line, net income. So net income is going to be driven by by revenues minus expenses. And where can we perceive how much net income the organization earned? Well, if it pays no dividends, if this organization is a not-for-profit and it has the non-distribution constraint, meaning it's not allowed to distribute earnings, then net income always equals retained earnings. And retained earnings affects the equity account. So what we can see from 2014 to 2015 is the equity account increased by $18,000. So it must have, and since it didn't have any external events affecting the equity account, then what must have happened was retained earnings increased by $18,000. Well, if net income equals retained earnings, then net income must be $18,000 this year. All right, so we're on our way. Now, moving farther down the line, and maybe even just moving backwards, continuing to move backwards, they didn't purchase any new property this year. So the fact that property, plant, and equipment went from 100 to 90 decreased is the result of depreciation. The stuff that they owned in 2014 was worth $100,000. A year's depreciation cost them $10,000 against their PPE. And so we know that the depreciation expense is $10,000. And then the only liability that they have apparently is their medical supplies. And medical supplies, they purchased all their supplies on account. Not clear. They're not saying that they didn't pay for it. Well, regardless, we have a increase in liabilities from $30,000 to $37,000. So there you have a $7,000 supply expense. So now total expenses, $7,000 plus $10,000 is $17,000. So therefore, if we know that expenses was $17,000 and net income was $18,000, and total revenue minus expenses is $18,000, we could say 18 plus 17 gives us $35,000 for total revenue. And if there were no bad accounts, there were no charity care, then net patient service revenue must be 35,000 as well. So that's relatively straightforward. If you know the interaction, right, on the balance sheet side, you can kind of back into, at least in this case, this very special case where there's a lot of unrealistic assumptions about the organization, you can kind of back into the income statement.